Loan products evolve and change every day, and there's windows of opportunity to take up a better product or a better offer, a better interest rate all the time. But unless as a borrower you're out there on the lookout for these kinds of things, you're not going to pick them up. So that's where your finance broker steps in, and if they know that you're on the lookout for something specific by way of changing your loan, then they can keep you informed of those opportunities that come up. Particularly when there's, for example, a specific interest rate discount that's been offered by select lenders for a very short period of time. That could be an opportunity that's missed if you're not actually on the lookout. You should also review your loans periodically, because life circumstances change as well. So what may have been set up originally for you to suit your life circumstances at the time may no longer be the case. So the original product may no longer be suitable for you, and it's important to accommodate those changes as they occur in your life as well. Borrowers should generally review their loans once a year, in exactly the same manner as you would with your household insurances. There's no difference there. In fact, there's a greater benefit in reviewing your loan every year than what there is your insurance as such, I guess, to a point, because there are significant savings that you could take advantage of by reviewing your loans. Or alternatively, if there's a key trigger, for example, when a 3-year fixed rate drops below a particular level, I will consider fixing my loan. That might be one of your triggers. You might be looking for a particular feature, in a loan, or a trigger in your life that may give you reason to actually review your loan. I'm planning to start a family, so therefore I may need to look at restructuring my loan to accommodate for that period of time in my life. These are the kind of triggers that borrowers need to be thinking about. By reviewing your loan on an annual basis, it doesn't necessarily mean that you're going to be refinancing. It might even just be to see whether your financial circumstances are on track, and the review could be the trigger for picking up something that may not have been obvious to you during that period. For example, you might be doing your budget, and you might find that you are struggling with your repayments, and this is the opportune time to revisit your loans and make sure that they are the most competitive at that particular point in time. Irrespective of when they might have been set up, they might have been the most competitive at that particular point in time, but over the course of months or years, lenders have introduced new products, new features, new benefits that you could be taking advantage of. The first part of a loan review is to check the overall financial circumstances of the borrower. For example, are all the repayments made on time? Have they had any difficulty meeting their repayments in the past? If so, then we need to address this first and as a priority over anything else, because if there's any financial hardship, that is more important than anything else at that particular point in time. The second part is in reviewing their goals and seeing if the loan is still suitable to accommodate those goals. I would then check whether there are more competitive options, and if so, conducting a cost-benefit analysis before making any recommendation at all is paramount, because if the cost to refinance significantly outweighs the benefit, then that's not something that I would be taking lightly. I would be certainly looking at what point the borrower will actually be breaking even and getting any benefit out of the refinance.